Exchange-traded funds, or ETFs, are a collection of securities that trade similar to index funds or mutual funds. By purchasing an ETF, you are essentially investing in hundreds or even thousands of different companies at the same time. A benefit to exchange-traded funds is often significant increase in diversification, as opposed to analyzing and buying single individual stocks. For investors who rely on dividend income, catastrophes or unforeseen events affecting one company that makes up a large portion of your portfolio income could be disastrous. For example, shareholders who relied on dividend income from AT&T to pay their bills were likely disappointed by the loss of income once the company completed its Warner Media spinoff and merger with Discovery Inc. The company effectively reduced its dividend payment to shareholders by 47%. This sort of drastic change in dividend income is unlikely to occur with a high dividend ETF. With that in mind, let's explore 5 high dividend ETFs that pay a higher than average yield compared to the S&P 500 index. First off, JP Morgan Equity Premium Income ETF, as its name implies, aims to provide investors with high amounts of dividend income. The fund was launched on May 20th, 2020, so it is relatively new. The ETF generates income through both selling options and investing in large cap U.S. stocks. At its current price of nearly $54 per share, this fund boasts a trailing dividend yield of 11.17%, which is astronomical, easily beating the roughly 2% dividend paid by your average ETF fund. It also pays dividends every month, which can be hugely beneficial to anyone attempting to use the dividends to pay for everyday life expenses. The fund is comprised of a healthy balance of sectors, with its top holdings belonging to industrial, financial, and healthcare-related fields. It is comprised of a large number of individual companies, with its largest individual holdings being United Health Group, the Hershey Company, Progressive Corp., and ExxonMobil. It is worth pointing out that even its largest holding represents only 1.65% of its total assets, reducing its overall risk exposure. Since part of the fund's dividends are derived from income generated by selling options on these companies, it is unlikely that the fund will ever experience massive price appreciation of the stock itself. Since if there was a large amount of appreciation in its holdings, the stock options that were sold would be called away, limiting its upside potential. Next up is the Schwab U.S. Dividend Equity ETF, stock ticker SCHD. The Schwab U.S. Dividend Equity ETF aims to track the total return of the Dow Jones U.S. Dividend 100 Index, which is comprised of high dividend-yielding stocks in the U.S. The fund dates back to October 20th, 2011, so it has some history to it. While these ETFs have lower overall dividend payouts than does the previously mentioned JP Morgan Equity Premium ETF, the remaining ETFs in this video generate their dividends through corporate revenue and not from selling options. This means that while these ETFs will pay out a lower overall dividend, there is a much higher chance for shares to appreciate in value. Overall, the fund has experienced significant and steady price appreciation since inception. However, the volatility of the events in the past year has caused the stock price to retreat slightly, losing 6.8% of its overall value. However, this is relatively solid compared to a more conventional ETF such as the SPDR 500, which tracks the value of the 500 largest companies in the U.S. and has lost nearly 20% in the last year and only pays out a meager 1.65% dividend. The fund's top 3 sectors are informational technology, financials, and consumer staples at 21.1%, 20.5%, and 14% weightings, respectively. And the fund's top 3 holdings are Merck & Company, Pfizer, and Pepsi at 4.3, 4.1, and 4.1 weightings, respectively. The fund is comprised of 101 securities in total. Next, the iShares Core High Dividend ETF, stock ticker HDV, aims to track the returns generated by U.S. stocks that offer a high dividend yields. Averaging a 9% annual total return on investment, this fund pays out a dividend rate of 3.54%. While the fund's quarterly dividends have been fairly erratic due to the volatility during this past year, some quarterly distributions were double that of other quarters. However, even with this volatility, it is important to keep in mind that its overall dividend payments has been growing at a rate of 7.17%. This allows for sustainable high-yield dividends while also enjoying strong long-term price appreciation of the underlying stock. Next, we have the Vanguard High Dividend Yield Index stock ticker VYM. The fund was established in 2006 and has survived the financial crash of 2008. Since it was founded right before the crash, it is no surprise that the fund's long-term growth rate is lower than that of other funds who were created immediately following the 2008 crash. But it still boasts an impressive 8.12% annual gains. One of the reasons for this is Vanguard's famously low expense ratios, which causes this fund to have very low overhead due to management expenses, with this fund having an expense ratio 15 times lower than many of its peers. The fund focuses primarily on large cap value style investments, which can be a solid investing strategy, especially during turbulent times, as rising interest rates are putting a severe constraint on more growth-oriented portfolios. The fund's largest holdings are in the financial sector, healthcare, and consumer staples. The fund consists of over 440 companies, so you are well diversified by investing in this ETF. However, the fund is a little more top-heavy with its largest holdings, including Johnson & Johnson comprising nearly 3.5% of the total fund. ExxonMobil, JP Morgan Chase, and Procter & Gamble each represent roughly 2.5% equity each. Finally, let's look at the iShares Select Dividend ETF, stock ticker DVY. This fund has held strong over the past year, only losing 1.43% of its value, which, as mentioned previously, is pretty phenomenal when compared to the broader market losing nearly 20% in the same time frame. Overall, the fund has experienced long-term steady growth, with obvious dips during the 2008 crash and during the COVID shutdown. The fund comprises a smaller total number of holdings than some of the other ETFs we've looked at, with 99 holdings in total. However, even though this fund is less diversified than some of its peers, it also boasts a lower price-to-expense ratio of under 12, meaning that the earnings in this fund are relatively high compared to the price of the fund itself. This gives the fund a 12-month trailing dividend yield of a solid 3.68%, easily more than double the average ETF dividend payout. As you can see, investing in high dividend ETFs can help stabilize your investing portfolio, as these funds tend to be focused on more stable, recession-proof sectors. These dividends can help you grow your portfolio over time, or provide that much-needed income to help you escape the rat race and live the type of lifestyle you've always dreamed about. If you found this video useful, be sure to subscribe to more videos on all things dividend investing, and as always, I'll see you all again next time. Thanks.